Hello, and thank you for joining us today. My name is Marc Montini, and my company is the Montini and Company Tax Advisory Group. In today's webinar, we're going to take about 10 minutes to talk about the one big beautiful bill, and specifically the taxation of your Social Security. Real brief about us. We are both a tax and financial planning firm. We definitely believe that tax and retirement planning go hand in hand. You can't do one without the other. We're a one-stop shop for your planning needs. I am a Series 65 licensed fiduciary and an independent financial advisor. I've been in financial services now for over 30 years. And as a firm, we specialize in reducing taxes, tax elimination. We do a lot of retirement income planning for people. Where's your money going to come from? Is it sustainable? And is it being taken in the most tax efficient manner possible? We do asset management, right? They all go hand in hand. And then we even do tax returns. So on our agenda today, we're going to talk about the one big beautiful bill and the taxation of your Social Security. And we're going to talk a couple things. What stayed the same? What laws were in place and what have not changed? And then what new provisions did the one big beautiful bill bring? And then lastly, is there anything that you should be doing to prepare? Let's start with what stays the same. Okay, your Social Security is still taxable, and the taxation of your Social Security is still a function of the income you have other than Social Security. So what is other income? That's going to be IRA distributions, earned income, interest income, dividend income, even tax-free municipal bond income. All of this is income other than Social Security that could cause your Social Security to get taxed. Now, the other thing that remains the same is that if you're over 65, you do get an additional deduction over and beyond on top of either your itemized deductions or on top of your standard deduction. You get $2,000 if you're filing as a single, and you get $1,600 a piece if you're a married couple for additional $3,200. So all of this remains the same. So again, how is this Social Security tax? So the parameters are this. If you're filing as a single and your other income is less than $25,000, then none of your Social Security is going to get taxed. If your other income is between $25,000 and $34,000 and you're filing as a single, you're going to have half of your Social Security get taxed. If your other income exceeds $34,000, you're going to have 85% of your Social Security getting taxed. If you're filing as a joint couple and you're married and your other income is under $32,000, none of your Social Security gets taxed. If your other income is between $32,000 and $44,000, you're going to have half of your Social Security getting taxed. And if your other income is greater than $44,000, then 85% of your Social Security gets taxed. All of this remains the same. All of this was in place before and has not changed. So what's new? How is it that we have no tax on Social Security? Well, a couple of things that they have added is they did increase the standard deduction across the board. So for everybody, if you were under 65, your standard deduction for a married couple is now $31,500. If you are filing as a single, your standard deduction is $15,750, and head of household is $23,625. These are also indexed to inflation, so we will expect to see them increase over time. So this is new. If you are under 65, these standard deductions are in place. Now, if you are 65 plus, the new changes are you're getting an additional deduction of $6,000 per person. And you get this regardless if you are itemizing your deductions or if you're taking the standard deduction and or if you're taking your Social Security. Regardless, if you are 65 plus, you are going to get $6,000 more in a deduction off of your taxes. Now, that $6,000 additional deduction does get phased out with income. So if you're single and your other income is $75,000 to $150,000, it will phase out. When you get to $150,000, it will go away. If you're filing as a married couple, if your other income is between $150,000 and $250,000, again, it will phase out, and at $250,000, that additional deduction will go away. When do we expect to see that? I don't really see that for my retired clients, but I will see that for clients that are 65 plus that are still working, in some of their prime earning years. You could have income like that that could phase out that additional $6,000 piece deduction. Now let's take a look at this on a tax return, okay? And we're going to make certain assumptions. Number one, we're assuming this couple is going to be 65 plus and they're filing jointly. So we are also assuming they have $40,000 in traditional IRA distributions. So it's going to move over from 4A over to 4B. We're also assuming that they have combined Social Security benefits of $40,000. Because their other income here is between $34,000 and $44,000, half of their Social Security benefits move over to the income column, and that becomes part of their total income, now giving us an amount of $60,000. Now, if they were under 65, okay, their standard deduction at that point would be $31,500. But because they are 65 plus, they're getting the old additional deduction of $1,600 apiece, so $3,200 more per couple, plus they're getting another $6,000 a person for another $12,000, which now moves their total standard deduction up to $46,700. That now reduces their taxable income down to $13,300 based on the current tax tables here. They would be paying zero tax on that $13,300. Now, what does this all mean for you? What should you be doing? How does this affect your potential retirement? Well, number one, we still encourage you, explore converting your traditional IRA into a Roth IRA. So if you have an old 401k, get it out of there. We have a whole bundle of reasons why it's beneficial to get out of a 401k and roll it into a traditional IRA. You can do that on a tax-free basis. Now, once you get it into that IRA, again, we do explore converting that traditional IRA into a Roth IRA. Now you got to be very careful because that is a taxable event. So converting into a Roth IRA may not be for everybody. Now we have a very, very good system of converting from a traditional IRA to a Roth to minimize the tax implications so you don't pay an excessive amount of tax during the course of a conversion. Why are we doing this still? Because these new provisions, this new $6,000 a piece a person deduction is not permanent, and it is set to sunset in 2028. So unless Congress acts, this additional deduction could go away. So we still want to plan for that and have as much tax-free money available to you in the future. The other thing you can do is request a free financial analysis report from me. I'm always happy to give you a second opinion, and I have a very extensive report that I'm happy to generate for you at no cost to analyze what are the total risks that you're taking that you may not be aware of, what are any potential hidden fees, again, that you may not be aware of, and what kind of diversification do you truly have in your portfolio. The second opinion, again, is available to you at no cost. If you want more information on doing a Roth conversion, I do have a webinar specifically dedicated to that. So if you go to montinico.com/webinars, you can see my entire library of webinars there. And specifically, you'll find one on the power of converting from your traditional IRA to a Roth. And with that, thank you very, very much. I hope this was helpful for you. And please reach out and let us know if we can help you in the future.